Good morning and welcome to the TR Property Investment Trust PLC investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the top right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself, and the pre-submitted questions have already been answered, and we'll publish the written responses to those post today's meeting. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Marcus Fairmarch, Fund Manager. Good morning to you, sir.
Good morning, and thank you very much on this lovely sunny day here in London. So as we've done this before, many of you will know the format. I'm going to aim to talk for roughly half an hour, a little bit about the positions of the trust, how we fared over the last 12 months, a bit more about the results, and then we'll run into current stock positioning ideas for the future. And I'm sure there'll be some questions around M&A and other activity in our sector. So without further ado, just spinning through a few slides. A couple of reminders. The trust is the mothership of what we manage, which is about 2.2 billion. The trust is about 1.1. You'll note a large number of different products. Here, I would call out property growth and income, which is a hybrid, a mixture of physical real estate, roughly 30%, and equities of 70%, and then a variety of equity-only funds that are either pan-European or global. But none of what we do in any of these funds, and particularly the trust, is possible without this very large team behind me. And again, many of you have seen this slide before, but I do like to highlight how long many of the team have been working together. Joe Elliott, our finance director, 19 years, Alban Lonneur and George Gay, 15 and 18 years respectively. They're key components of the team as the other fund managers, George on the physical side, Alban on the real estate equities, but importantly backed up by an army of analysts and support as well. So all very important. And then really just to highlight some numbers for you. It was a good result for the year to March 24. Always pleasing to see us get over 20%, both in terms of NAV and share price total return. But obviously encouragingly and importantly for the manager is that generation of alpha over 500 basis points, difference between 21 and 15.5, which I'm very pleased to say sort of reinforces our long-term average, which has been over 400 basis points of alpha after costs, ahead of the benchmark over the 13 years that I've run the fund. And then, beginning of the new financial year, things have been a little more modest. And actually, if we roll this forward to more recently, to the last week of June, those numbers are pretty well flat. And we'll talk about that a bit later. You will note that we're two things on this page. We're trading at a large discount, which is a little bit larger than traditionally we would expect, given the improving backdrop, both from a macro cost of money perspective, but also from market fundamentals. So I'm a little surprised by that. And we've been out banging the drum, highlighting how cheap the sector, how cheap the stock is. You'll also note physical property is at its lowest point ever, 3.6% of net assets. That's because we've recently sold our largest asset, the Colonnades. We'll talk about that a bit later. But expect that to go back up when we find the right assets. But in the meantime, buying real estate equities at very healthy discounts to revised asset values, of course, is the right thing to be doing. And then our potential to gear. We've been taking a few chips off the table in the last few weeks, just around the sort of political turmoil, particularly in France. But I should suspect that we'll see that climbing again in due course. And then just a reminder of relative and absolute performance. bit of smoke blowing, but you've seen that slide before. And then importantly, ESG. As far as we are concerned, we have control over our physical property, and we do a very good job, best-in-class job in ensuring that our buildings are moving up towards the A and B rating, which they need to be by 2030. But more importantly, we're obviously also helping and cajoling our companies that we're invested in to make sure that that they are continuing to enhance their standards of governance. And of course, from an ESG point of view, the G part, we're all over. Social is pretty clear. Property is about the environment that we all live, work, and play in. And then the environmental issue, of course, is a constant and forward-moving one, and we're continuing to press our companies to improve on those. And then in terms of our physical assets, as you can see here, we're doing everything that we can for where we have direct control. Okay, back to the broader picture on the trust. We're very proud of this. Property, of course, is an income stream dominated asset class, and you will note that the board did increase the dividend a little bit, albeit that we have therefore dipped into reserves for this year to make up the shortfall. Now, this shortfall was explained in detail in the annual report, and I can give more colour if anybody has any particular questions on that. And then just a couple of big picture points. Many of you would have seen this slide before, but I think it's more relevant than ever. The fundamentals for real estate, an income stream with a capital kicker all through the zero interest rate period. It was all about yield comparison, that margin over fixed income. We're now moving back to a much more traditional cycle and environment where essentially you're backing rental growth. You need to make sure you are exposed to asset classes and subsectors where you can see that rental growth, and that's coming through not only where you have tenant demand stability, but really importantly, lack of supply of new space. That's the thing that's making me feel warm and fuzzy, is that so many of our markets have seen, very, very little new supply, which really goes all the way back to the GFC and the complete suspension of traditional lenders post 2008, and then of course another deferral and development cycle through COVID, and then now more recently the fact that build costs have gone up so much. So we've got many markets where assets are trading below rebuild costs, so no one's going to build any more of them. And then the third leg of this particular tripod has been indexation, where of course we've benefited hugely in terms of our revenue from indexation, particularly in continental Europe. And then, of course, we're only buying a little bit of the physical real estate. The vast majority of our portfolio, 96%, is, of course, buying equities. And there we have many shares trading at large discounts, which over the last 12, 18, 24 months have been reflecting rising debt costs. But as I'll show you later, so many of our companies have now essentially resolved that risk to rising debt costs through either restructuring, rebuilding balance sheets, hedging, swapping strategies, etc. And then another just reminder, this is unlevered total returns from commercial property. Again, some of you will have seen this slide before, but it's just worth highlighting, how stable that income account is over many, many years. And then, of course, the capital account is a bit more party hangover. But what I would like to stress is essentially there are two kind of forms of illness for real estate. One is that you overdevelop, which led to the long recession of the early 90s, where it took a very long time for us to absorb all that oversupply, and rents just fell significantly through those first half of the decade. And then, of course, more recently, the GFC, which was all about not only a dramatic change in the cost of capital, but actually its availability. And then more recently, it's been not about availability, but about a dramatic change in cost. And I would argue that we're through that now, and we expect to see capital values recover now from excuse me, from their new low base. And then how has that been reflected in the equity market? Well, again, you can see our annus horribilis in 2022, and then we had a couple of false dawns, both in seems to be around Halloween, October 22, and then again October 23, both of which led to the market giving up those gains when there was a realization that possibly the central banks weren't able to call time on rising interest rates or to have inflation under control. But as we move into the summer this year, I think there's a general feeling, or you can see it, it's not a feeling, it's a fact. Those inflation data just keeps on rattling down, and we've had much more dovish commentary from the Bank of England and the ECB. And of course, I think it's the Swiss National Bank have now cut rates twice. So I think the path and once again, once we will once again see reach a peak and move beyond peak. But I think it's very important to realize that our bullishness is not predicated on rates coming down dramatically. It's just the psychology of getting past the peak and being into a new post-peak environment. And then when we look at how property companies using the traditional metric of discounts to asset value, and we look at it over a long period of time, what you will see is that when as asset values are falling, of course, markets require ever larger discounts to that falling number, as they don't want to catch the falling knife. They're looking for protection all the way down. Discounts start to widen very dramatically. And then when you get this inflection point where markets start to say, well, look, we're already trading at a very big discount to a number that has already at least partially corrected. The risk has become asymmetric. There's a greater likelihood of values rising rather than falling. You get this snap back in that discount, and it starts to narrow. And we've seen it, as you can see, on multiple occasions over this 30-year time series, and that's where we are now. We are snapping back upwards as NAVs stabilize and people come to trust those NAVs. Many of you would have heard me talk about NAV standing for not actual value, but in a huge number of our subsectors, we're now confident that we're getting clearing pricing, and asset values are now provable in many markets. And then the last slide on this big macro story, I just asked the team to look at the last 4 cyclical peaks in interest rates and literally just compare global real estate equity performance versus global equities in the 3, 6, and 12 months after the point of peak. These are all very different cycles, all very different economic backdrops. And what you will see is what we would expect. We are a levered asset class that was damaged significantly on the way down when the cost of money shot up. And therefore, if we start to see stability in that cost of money, or it even starts to decline, but literally margins and those lenders become more competitive, then as you can see, we do better than the wider market, which is what you would expect. Okay, turning a bit more to the portfolio, to remind you, we're very much pan-European. In fact, we have more exposure to continental Europe than we do to the UK. However, we are actually overweight the UK relative to the benchmark, but in absolute terms, we're very, very continental. But the way we look at the world is not necessarily through geography. It's actually about sector positioning. Now, you'll see the way we divide the world up is sometimes it's very pan-European, such as we lump all industrials together because those macro drivers are not country specific. They're much more about the asset class. Meanwhile, retail in the UK, we separate between London and the rest of the UK. Student housing, again, is a pan-European phenomena, and we can run through all of these. The way we look at the world on the right-hand side is those subsectors that we are most overweight to. Doesn't mean where we have, particularly where we have neutrality in something like student housing, we're very positive about student housing. We just think that the stocks that we can buy, which is the likes of Unite in the UK and Exior in Belgium and the Netherlands, that they are just fully valued. They're attractive businesses, but we think they're fully valued. So to get into the bottom half of this chart on the right hand side, that's not only are we concerned about the prospects for the asset, so for the subsector, for the asset class, but more importantly, we are also concerned about pricing at the equity level in that subsector. Okay, and then just moving on to how things have evolved during 23. We saw us pick up a lot more deep value. The market had corrected severely and then rallied late into 22, and then given back those gains, and we were sort of rumbling along through much of 23, and that gave us an opportunity to pick up a lot of what we consider to be deep value. There have been stocks that were out of favor that have been sort of hit hard. We also liked at the same time those markets where we were seeing proper macro tailwinds, and that was particularly in the industrial sector, Catena in Sweden, Sargax mainly in Sweden, but also in Germany and Benelux, and then Sirius being a workspace in Germany and actually in the UK. And then we took profits. As you can see, we had a big holding in Industrial REIT that was taken private by Blackstone right at the beginning of our financial year last year. So this was the 6th of April, 2023. And that, we felt that was going to ricochet around the market. So we bought some shares in Urban Logistics REIT and Warehouse REIT, both of which we have sold a long time ago. We're very concerned about these externally managed businesses trading on these very large discounts to asset value, but absolutely refusing to buy back shares at huge discounts. And instead, both of them are being busy buying assets at market price, at par, plus cost. So that's what we describe very much as financial incontinence. And then, we did continue to double down in our lack of office exposure, selling out right at the beginning of the last financial year out of Great Portland and also Fabergé. And then Convivio, interestingly, is something that we've now is a diversified REIT. Having sold it then, we're back buying it now because of its exposure to hotels and residential. And then turning to Q1 this year, here again, adding beta. What we mean by that, these are stocks which are going to respond, what we think will respond very strongly to any changes in expectation on interest rates, i.e. the market rates get cut faster than the market expects. These names will do very well. Capital raises, we're starting to see those coming through. We participated hugely in the SEGRO raise. That was a 800 million upscale to 900 million. It was at £8.20. SEGRO's share price today is £9.15. And again, Argan, a small business, logistics business, family owned, family controlled, 50% family owned by the Lalonde family. Very successful French logistics developer. First raise for 17 years. It finally realized it needed to accelerate. There's so much demand from nearshoring and onshoring. Great business. We've done really well out of that. And then M&A potential, we'll probably talk a bit more about this. We tend to rotate quite rapidly through these names like Tritax Eurobox, which is obviously currently the subject of press speculation, that a private equity house is looking at them. And then Aberdeen, who've now moved into a managed wind up as the board strategy. So we'll see how that gets on. We don't own any of that Aberdeen vehicle at the moment, with just a little bit of Eurobox. And then we've been selling out of the weaker income growth. So this is not that we have any fundamental problem with Assura or PHP, as as businesses in terms of their income streams. It's just the fact that they're really, going to struggle to grow their rents. They're being strangled by the Valuation Office, so the government department acting for the NHS, which is really preventing or making it very difficult for them to increase rents. And then Safe Store, which is a stock that we had been selling out of, where its rate of growth has stalled, both in terms of occupancy and where it can push its rents. A great business. We will come back to, I'm sure, at a later date, but it's just suffering from some of those short-term tailwinds. And then physical property, we have now sold the Colonnades in Bayswater, which was I'll come back to the Colonnades in Bayswater a bit later. We've got another slide on it, but it's something definitely worth touching on as an example of what we can do with an asset over a long period of time. And then in terms of finishing off with the sort of bullish case for the market, we've talked about fundamentals improving in so many of our subsectors. We've talked about cost of debt peaking, and at the end of the day, when we look at the whole of our universe, we have an LTV of 32-33%. I mean, relative to private equity and private real estate vehicles, the listed space is very cautious, very carefully managed, even though the balance sheets have been very carefully managed. So when you look at these big discounts, you think the market is really jumping at shadows. We think so many of our businesses are in a really good place. And then the last sort of leg of the stool is, we only about 8 or 9% of all institutional quality real estate in the UK is actually across Europe is actually owned by listed companies. So a little bit higher in the US. But i.e. the asset classes can be owned privately, publicly, etc. And what you'll see on the right-hand side was this surge of public to private when money was very cheap. But then we've seen that more recently with Industrial REIT and then Civitas. We own 12% of Industrial REIT. I talked about that. We don't own Civitas. Anything in bold letters you can see, we were big or certainly significant shareholders in. We absolutely backed the merger of London Metric acquiring CTPT and then acquiring LXI. We think those are very smart moves by Andrew Jones and his team, and that's moved them up into the FTSE 100. We voted against the merger of Tritax Big Box and UK Commercial. Essentially, these are two externally managed vehicles, where Tritax is majority owned by Aberdeen, and UK Commercial Property REIT is also managed by Aberdeen, and the largest shareholder in UK Commercial, which is called Phoenix Life, have a long-term, have a cross-holding with Aberdeen, and also a publicly available, publicly known about fee rebate, and so therefore they were clearly very keen to maintain that fee rebate and drive the merger of those two companies. The sadness for us is that UK Commercial has a great portfolio, but Tritax are going to be selling or aim to be selling 40 to 45% of those assets, which don't fit their AnyBox strategy. So disappointing. Right, and then moving on, we are now down to our last two assets in physical property, but I would highlight that at Wandsworth we're carrying out a significant refurbishment program, and we're nowhere near. We've only just started that rolling refurbishment program, and we've already got significant interest in some of those refurbished units. So we'll just keep our fingers crossed on working through on that. And then just coming back to the Colonnades in Bayswater, I'm often asked, why do you bother with owning physical real estate? And to remind investors, there are three clear reasons. The first is we want to make money out of it. Secondly is to show you, the the shareholders that we can actually do what we're asking these companies to do, and therefore we know that we can ask these companies the right questions when they come in and say they're going to get planning in X months and it's going to cost Y, etc. And we know whether they're telling us something that's actually likely to be true or not. And then the final leg of the stool is for us is market information. You know, real estate is a private market, and the more we're in that market, buying and selling, or certainly being involved in bidding on property, we can get some fantastic real live pricing data. But sometimes we like to own real estate for a very long time. This was the first piece of property that I bought, having joined Chris Turner, the previous fund manager, when we were at Henderson Investors in 1997. So I've now celebrated 25 years of working on TR property. My wife calls it the third child. But this is an asset that we were really proud of what we've done. And, you know, we made money out of selling lease extensions on the residential. We brought in Waitrose and built a 44,000 square foot first floor for them, and then a whole lot of other lease extension, new leases to those tenants on the ground floor. Really exciting. And then we sold it a few months ago. And in fact, by coincidence, reinvested almost all the 33.5 million proceeds straight into the SEGRO capital raise at £8.20, and the shares are now £9.17. So, you know, a good recycling of capital. And then the Ferrier Street industrial estate, the one we're refurbishing, just want to highlight on the right-hand side, you know, that's rental growth. That is what our rents are doing. And we got up to 1.4 million, and we expect to exceed that post our refurbishment. Okay, and as we come up to the magic half hour slot, just to sort of pull a few things together. A lot of this will be very obvious to you. Where we say bank margins widened and investor sentiment weakened, I think that's now looking increasingly historic. And when we look at, you know, at the end of the day, all of that bad news is reflected. We are expecting policy rates to have peaked, and then crucially for us, there's little evidence of weakness at the occupational level in our favoured markets. Now, just to highlight how specific you have to be, here in central London, we are very happy to own exposure to the West End. We're happy to own exposure to the campuses that are available through Land Securities at Victoria, and to some extent Paddington Basin and Broadgate through British Land. But vacancy in the West End is at 3 or 4%. Midtown 7%, the city market probably 10%. So that's getting problematic outside of that on top of the Broadgate scheme. And the market you do not want to be exposed to at all, of course, is Docklands, where vacancy has touched 15%. So it is very much horses for courses. But crucially for us, there's this lack of development activity, meaning so little supply and real estate trading below rebuild cost. There is very good liquidity for well-capitalized companies. They are able to raise capital. I mean, they raise equity or debt. You saw that with Great Portland on what one might argue was a slightly defensive rights issue, but they've made it feel and look offensive, and we'll see how they get on with that money. And then M&A activity. Obviously, we didn't own shares in Custodian REIT and Aberdeen Property Income, but we were disappointed for shareholders that they didn't merge, and that shareholders felt some shareholders wanted to go down the wind down route. I think that'll be very dangerous. I wouldn't encourage that. I think it takes a long time, and you often get left with a tail of assets. We have BCPT, where there's a strategic review has been announced. Obviously, we've got the EBOX situation, about Aberdeen European logistics, and there may well be more, which will all undoubtedly provide an underpin for values. Okie dokie. I think that brings to an end the formal part of the presentation. And I'm going to hand back to Peter to just deal with any Q&A.
Yes, thanks, Marcus, and thank you everyone for joining us. Just a reminder, if you want to put a question into the chat, please do so. We had 6 pre-submitted questions which we've answered, and the answers will be published after the event. But lo and behold, a couple of questions have been, or very similar questions have been asked, Marcus, so we might as well touch on them. So first of all, succession planning. You've been at the helm for quite a while. Can you just update listeners about the succession planning and what your thoughts are for the future of the trust?
Yes, thank you for the question. So first of all, on succession planning, Alban Lanier has worked with me for 15 years. He's the fund manager on a large number of our other strategies, and has been the formal deputy fund manager on the trust for many years. And therefore, I feel entirely confident that if I was hit by a bus tomorrow, the trust would be in sound hands, and the board feels the same way. As far as long-term planning, I'm 56 years old. I have no intentions of retiring at the moment, as long as I continue to deliver for investors, and the board still wants me to manage the trust. I do still have quite a lot of school fees to pay as well. So yeah, there's no. So from a long-term planning perspective, clearly Alban is the deputy fund manager, and then in terms of should something happen to me in the short run, then you are in capable hands. Plus, we have a full team here. We work highly collegiately. We've worked together for many years. We run each other's products when the other is taking a few days off, etc. So I'm very happy and to hand the trust to the management to him in the event of something happening.
Not sure many of us believe the 56-year-old bit, but anyway, thanks for that. Changing tack slightly, and the question that you get asked a lot: the look-through discount, taking account the discounts in the portfolio. I know it's difficult to calculate, but could you mention your thoughts on that at the moment, please?
Yeah, I mean, this is many people ask me about this, and the answer is I'm very careful with the number, partly because it's moving around the whole time, and partly because I tend to be a buyer of quality rather than very, very deep value discount names, unless it's there's an event that I can see that's going to change why that discount exists. But roughly, our sector pan Europe is still in the mid-20s. So on top of that, you add the discount of the trust and you move yourself to the sort of mid-30s. Where I would caution you is, well, the first thing is that you may think, well, why is it not wider than that? That's because we still feel very optimistic about industrial, logistics, both urban, last mile, and to an extent, big box as well, particularly big box on continental Europe. And therefore, the discounts are much narrower, or in some cases trading at premiums in that particular subsector. I would also highlight that there are some markets where, particularly in continental Europe, where the valuation community are still behind the curve, where they tend to mark to model, as it were. They adjust their discount rate rather than looking at market. And then whereas in the UK we tend to mark to market, so that the NAVs are much more realistic or closer to reality. But at the end of the day, it's very difficult for the valuation community everywhere, because they are looking backwards at evidence or lack of evidence in certain sub-markets, and only now we're getting pricing. So I'm always very careful to make sure that remind investors that valuation is an art, not a science. And it's really when the sell side teenage scribblers announce that a company's missed its consensus NAV by 1% or 2%, I just take that with a pinch of salt, because it's no different to you asking 3 estate agents to value your house. The spread they'll probably come up with is 5, 6, 7%, and that's in a liquid residential market. Today, Land Securities announced that it has bought another slug piece, a share of Blue Water. It got it at an 11 discount to its the last published asset value. So, which number is correct? You could argue that the seller of that didn't really have anyone else to sell it to. There was no other buyer for a non-controlling stake in a very large shopping centre. What's the right number? So I think for us, we're very much focused, as well as obviously keeping a very close eye on these asset values, particularly when it comes to takeout and privatization. We are very much looking at that recurring earnings and that credibility about value growth. So are yields moving in or out? Is there rental growth? Is there development profit? Are these businesses doing the right thing? And we still focus very much on that liability side of the balance sheet as well.
Thank you. Quick question about a copy of the slides. Yes, I can answer that. There will be a copy provided to you after the webinar. We do have to get them through compliance for retail purposes, but that takes a little bit longer than I would like. But slides will be available post the webinar. Next question is, given the UK's high debt level, is it reasonable to expect interest rates to fall when just refinancing existing debt will be difficult? Is your positioning going forward taking a less rosy scenario into account?
That's a very good question, and I'm a bottom-up real estate stock picker and have been for 25 years. Markets are currently very macro-driven, but as I said, well, I hope I said, because I've been giving quite a lot of these presentations recently, so apologies I didn't mention it. But we are, our central case is not that rates fall significantly. We get 1 or 2 cuts maximum this year, back end of 24, and then central banks are almost certainly likely to pause to see how things move in 25. We don't need rates to fall dramatically given where share prices are today. We need stability, and we need more pricing evidence to come through. We need banks' margins or lenders' margins to get skinnier as they get competitive again. And we will see some distress in the market, because there are plenty of people who borrowed 5 years ago on an all-in at 2.5, whose 5-year deals are coming to an end, and they need to refinance. Now, actually, this is where the listed space has an opportunity. And there is, to raise external capital, but also because a lot of them, their LTVs are not dramatically high. Now, there are exceptions. There is a business out there called Regional REIT, which has an LTV of well into the 50s. It's got a retail bond that it needs to refinance in the next month or so, and that share price has fallen from 70 odd pence to the low 20s. So reflecting quite rightly what investors consider to be very serious amounts of risk. 2 years ago, we were in 22. We were very much rolling out the 2008 playbook, which was to focus on the liability side of the balance sheet, not on the asset side necessarily. We're now moving, as I said, we're moving through that, and these companies are, take a company like Picton Property. It's just sold a large asset, which is an office building. It's converted into residential, or has residential consent. It's paid down all its RCF. It's got LTV in the 20s, high 20s, and all the debt fixed till I think it's 2028. I mean, what's not to like there? And the stock's trading on a massive discount. It doesn't make any sense at all. Just keep buying that company. And the share price is 68, and the asset value is 96. I mean, it's so yes, for us it's absolutely about looking at that balance sheet, but big picture, not predicting huge number of cuts.
Okay, next question. What percentage of the UK listed property sector do you expect to disappear in the next 12 to 24 months? And would this be merger or take private led? And finally, which would you prefer?
Right, well, I can answer the last part easily. Because no turkey votes for Christmas. I, of course, want consolidation rather than privatization. I believe that we need a listed sector. I think that with the death of the open-ended daily dealing property fund, which, by the way, were 6 words that shouldn't be in the same sentence. And that was something that I put in my strapline when I launched my hybrid vehicle in 2005. It is, the REIT space is, and if we were US investors, our 401k would have, we would own some REITs, or a fund that invests in REITs, because that will be our exposure to commercial property. And that's very much as it should be. You want to be able to be in permanent capital vehicles where you can get your money in and out by selling in the secondary market, and the manager can get on and run the long term, what is fundamentally a long term business. So absolutely, and I think, by the way, consolidation is the way forward. Particularly in the wealth management community, there have been the traditional owners of a lot of these small companies, and particularly a lot of externally managed vehicles that were created during the zero interest rate period. These businesses at 3, 4, 500 million market cap, they're just too small now, and they need to get together. And then there are, of course, huge synergies available. I mean, you take the example of Mackay Securities that TR Props was a big investor in. It was acquired by Workspace. I think Mackay had 19 employees, and Workspace took just one of them because it was able to absorb all of those assets into its existing management platform. And just, and at the same time, of course, it could cut out a whole lot of other admin overhead, etc. as well. And you see that all the time. Look at the CTPT being acquired by London Metric. Again, they didn't take on new people to run that. So absolutely, we would like a consolidation, and therefore, and I think it's a shame when you get 2 companies that work very hard to get together. Boards recommended it, and I'm thinking about API and Custodian REIT, and then some shareholders, I don't know, were under, I think, a bit of a misapprehension that you're going to be able to sell that asset and get more money back in a wind down, which, I mark my words, is incredibly difficult to sell the tail of any portfolio. You've got to keep your whole structure running whilst your portfolio is getting smaller and smaller. Very, very, very difficult. I can't give you percentages, but I really hope that there isn't, I'm confident there isn't a single board out there that isn't looking closely at what it should do. The days of ignoring activist shareholders or people who just want to do the right thing, those days are long gone. And woe betide a chairman who's found, or chair who's found to be not engaging with the register on the future of the company. And we do want them to survive. That's the important thing. They just need to get together to do so, to make themselves bigger.
Okay, then on the flip side of that is the IPO market. Were you disappointed about the special opportunities IPO that didn't get away? And this was a question that was in the pre-submitted questions, but it's also been mentioned live. Do you think this indicates that institutional investors have yet to climb the wall of worry on real estate, or were there more specific reasons why it didn't get away?
Yeah, so answering those in each in turn, yes, we were disappointed. We were a public cornerstone in that vehicle. The reason, quite simply, there were 2 reasons. One, I think the market timing is excellent. I think we are at an inflection point. There are, as we've mentioned, there are always going to be people who've borrowed money very cheaply and have now find themselves in a refinancing situation, particularly if they're it's private capital vehicle, and an operator's got the carry and that's disappeared, etc. They want to get out. So yes, I thought that Simon Lee and the team's timing was excellent. Of course, if the rest of the market is trading at a discount and you are IPOing clearly a cash box at £1, you got to pay some broker fees. So you do start with 98p of cash and £1. But the idea is that if you wait until the market is all trading, the equity market's trading back at a premium because everything's looking rosy, then of course you are going to miss the opportunity to buy those discounted deals in the market. The point whoever's asked the question, the point you've made very well in terms of referring to the wall of worry. The second thing we liked particularly was the internal management structure and the alignment. Management were unable to make any money out of this until we, all shareholders, had our money back, plus return, plus the hurdle, etc., in cash. and then the management team would earn alongside us as they exceeded the minimum hurdles. And I think that's completely appropriate and actually something that I really wanted to encourage, because one of the issues we've got with these externally managed businesses is that the exception was LXI, Simon Lee's previous vehicle, where the fee was based on market cap. So as the share price fell in the downturn, you knew as a shareholder that management was feeling the pain alongside you. Whereas at the moment, with all the other vehicles out there, they're being, the manager is feeing on an ad valorem fee based on an NAV that's up here and a share price that's down here. This morning we've seen warehouse REITs results trading at a 35% discount to its asset value. When I asked the question, why are you not buying back your own portfolio at a 35% discount rather than going and buying an asset in the market plus cost? The answer was it was being discussed with the board, and they wanted to, the board had agreed that they could exceed their hurdle of 10%. It was an answer I didn't really understand at all, and actually doesn't make any sense. It's sort of financial incontinence. But anyway, so I hope that answers the question. I would just add that clearly you saw the press articles around the fact that the team behind Special Opportunities REIT had worked alongside or in Alvarium alongside the team that had created and managed Home REIT. That of course is clearly some smoke there, but I'm pretty confident, having spent a lot of time with the management team, that was a different part of the business, and these, I felt that they shouldn't be tarred with that particular brush.
Lovely. Okay, moving on to Europe then briefly. I've got two questions. The first is, with European property, how have you approached currency risk? Have you de facto taken a view on sterling?
That's a great question, and thank you for asking it, because I should always highlight this. We run the currency for the trust in line with the currency exposure of the benchmark, and the reason we do that, quite simply, is the board, this is going back more than 15 years, never wanted the manager to have a tailwind of accidentally, over investing in a particular currency, the Swedish krona, and finding Swedish stocks, and finding that we then got a carry because the Swedish krona strengthened against sterling in the subsequent period. In the same way that we as the manager have no idea where the euro sterling relationship is going to be in 6 months' time, nor do we want that headwind. So when you buy a share in TR Property, you are getting that multi-currency exposure. Now, where we are underinvested in a particular sector, let's say hypothetically, make it an easy one, Switzerland, which is about 7% of our benchmark. If we have 5% of the fund's exposure to those Swiss property companies, then we then buy forward in the Swiss franc to make up the difference. So that's how we do it. What this means is that when I say to the board, this is my alpha generation, or lack of it, they know that is not being in any way impacted positively or negatively by currency. But it means, as you and I, as shareholders, we are absolutely taking that we are getting that currency exposure essentially back into sterling, which is where the NAV is priced.
Thank you. And staying in our note, says the viewer here, the trust is overweight in German residential. How exposed are you if plans to expropriate Berlin properties comes to pass?
Great question, and thank you for asking it. 2 points to make here. The first is that relative to the benchmark, we are not overexposed. We're market neutral. And secondly, a large proportion of our exposure from a relative point of view is to a business called Phoenix Free Deutschland, which actually owns only high-end Berlin property, and where it has a continuation vote in 6 months' time, a year's time, but where the board have already begun to incentivize the management team to sell assets. Essentially, this is a wind up in or an asset sale over time. But crucially, and I'm getting a bit in the weeds here, if you go into the Phoenix Spree Deutschland report, you will see that they have the opportunity to what they call condominionize 75% of their portfolio. So it's a block of flats, imagine with 20 flats in it. Traditionally, all of those flats will be tenanted to regulated tenants who would have a right to remain. And if a tenant left, you could only put another regulated tenant in. But if you spent years and years getting a particular planning permission, which Phoenix Spree have done for the last for donkey's years, they now have this permission that when the tenant moves out, actually in these cases they can refurbish the flat and sell it with vacant possession. Now, essentially, that vacant possession value is somewhere between 25 and 35% more than the value as a regulated lease, because the regulated lease is a sub-market rent. So there's a real opportunity here. And now the NAV, the published NAV, is around £4. It's a UK listed company. We don't think it's as high as that. We think it's probably closer to £3. Because again, the valuation is historically inflated. But with the share price at 160, I'm happy to own an awful lot of it and buy more. So I would say that's a special situation. As far as the risk of broader expropriation, I think that has been well and truly settled with two things by the Supreme Court in Germany, essentially saying that rents, you cannot control rents at the state level. And then I think the chances of a total destabilization, which would allow, you couldn't do it within Berlin itself. It would have to then be, again, because it's a federal decision, it would have to then be a countrywide expropriation, which, of course, you might say anything could happen, but I think the likelihood of it, and we are dealing in probabilities here, is extremely low.
Thank you. Back towards dividend payments. Are dividend payments made by the trust fully funded from income or capital for 2024?
So for 2024, you'll see that we're paying a slightly uncovered dividend. The board, as covered in the report and accounts in a lot of detail, the board have busily built reserves up over many years in order to ensure that when we had a moment where there was a dip in revenue, and I would argue that, essentially the hangover from COVID, followed by the dramatic change in the cost of capital, led to a situation where we therefore dipped into those reserves. Now, interestingly, we did dip into them in the year to March 22. We then didn't need to dip into them March 23. In fact, our payout ratio in the year to March 23 was 94%, so we put them back into the reserves, and then the year to March 24 we have now used them again. The reason that the board put the dividend up is because when you look at our trajectory of rental growth and dividend growth over the next couple of years, we are, as we stand today, confident of returning to full payout over that period. But the purpose of having those reserves, those revenue reserves, are exactly for the situation that we find ourselves in now, but where we're already clearly building our way out of, because you only have to look at companies reporting. So those we've had, not only those with the December year end reporting in February, but also, more important, I suppose, the ones with a March year end that reported more recently in May. We are, with the exception of some stocks in Sweden and some of the Germans, everywhere else we are seeing healthy dividend growth, which is what you would expect, given what I talked about, both the fundamental situation in underlying market, so market rental growth, but more importantly, the fact that this interest cost leakage has either slowed or stopped, because so much of our businesses have caps or swaps or fixed, etc. So we can see a reasonably clear trajectory on revenue. Now, that can always be destabilized by external forces, but we've got to work with what we've got. And more importantly, revenue reserves today are about 12 pence. and therefore if you're paying out sort of circa 15, it gives you a lot of comfort, or should give you a lot of comfort in terms of the amount of reserves.
Okay, we're approaching the hour, so maybe time for just 2 more questions before we wrap up. First one, how do you think the low occupancy for office space, such as in the Docklands, plays out? Are alternative uses realistic?
It's a good question. So, and again, I'm just trying to give a short answer, which as you for those who follow me know how hard it is. But essentially, yes, some of those buildings can be repurposed efficiently, but those with the very deepest floor plates, because at the end of the day, if you can't, you're not getting light into the middle of the building, it's going to be a lot harder, and they will have to come up with some rather clever architectural engineered solutions. In terms of there'll be some low rise, which they'll probably demolish in due course and build residential as essentially an inner London suburb. What a superb place to live. I mean, you've got fantastic transport, you've got lots of retail, lots of restaurants, you've got the water, etc., lots of space. The Elizabeth, the communications have improved immeasurably. So as a mixed use environment, I absolutely see a future for Docklands and for Canary Wharf. The problem you've got is what valuation that the current owners are holding those assets at. And if that is too high, then you're going to have that residual land and building valuations have to come down before you then build it up. So alternative uses will become profitable, but possibly only when you've rebased the underlying value. Now, this is I'm just going to segue briefly into, we do have something called permitted development in the UK, which is a government-designed scheme to bypass local authorities who didn't want to see a loss of redundant office space because they hoped they might one day get a tenant and pay rates, and they didn't want the stuff converted into flats for people who might not vote in the same way as the colour of that particular local authority. But really, the government have said, look, we've got to bypass politics here, and we've got to make sure we see conversion of those older office buildings. And there, the rule of thumb is if your end product has a capital value, so your converted building into flats at sort of circa 350, 400 pounds per foot, then it kind of makes sense because of the cost of construction. That's after you've brought the value down of the old knackered office building to the right value. What that means is that in the Greater London area, you're up to sort of in a ring road of sort of Croydon, St Albans, etc. You'll see a lot of conversion of that. And in TR Property, we had a very successful sale of a building in Vauxhall, which was an old laundry that had become sort of multi-use industrial offices, and we've sold that this was a couple of years ago, 4 years ago now, to a residential developer. So we will see there are, it's just about where you bring the book cost down.
And a slightly related theme, finally, to finish then, talking of alternative uses, what's your view on data centers?
Great question. So we could spend an hour on this, but quite simply, there are effectively 2 types of data centers. What we call a powered box, where you as the developer, this is what Segro are doing, particularly on the Slough trading estate, where they have very good power provision, is essentially you build a building and you are providing the power, and the data center operator is then filling it with hugely valuable amounts of kit. In fact, the contents are many multiples of the cost of construction. The other is to deliver a full service where you are a landlord and you're going to actually provide all the money to the co-locator, to the hyperscaler, to actually build and operate this building. This is what Merlin are trying to do in Spain. To us, that's much more fraught with risk. And again, the whole thing boils down to power, essentially, and be able to get access to that. I think it's a very interesting space. I think the markets will get a little carried away, and Segro have been very careful to say, look, even when we look at this in 2028, it's going to be, high single digits of our portfolio. The folks at Merlin are being much more optimistic and because they want to divert attention away from their office and their shopping centres that aren't doing so well. But yeah, I mean, as an asset class, no different to towers, we are going to see this area grow. But I think one has to be careful to believe that there's a whole bunch of people out there who can suddenly deliver this stuff, because they can't unless you're already plugged into the network.
Okay, we'll wrap up there. Thank you, everyone, for your questions. If we didn't get to your question, we will respond after the event, and they'll be available on the IMC website. But if I can ask you just for some closing comments, Marcus, before we wrap.
Thanks, Peter. And ladies and gentlemen, thank you so much for listening to me again. Our website is up to speed the whole time. So I was giving another podcast on moneymakers the other day. That'll be on there. And our AGM is around the corner, so do please come and have a cup of tea with us at the RAC in July. Otherwise, if you have any questions, do put them on the inquiries at trproperty.com website as well. I will endeavour to get back to them. And last and not least, thank you very much for your support over many years. Have a good day.
Perfect. Marcus, Peter, thank you very much for updating investors today. Can I please ask investors not to close the session, as you'll now be automatically redirected? Provide your feedback in order that the management team can better understand your views and expectations. This will then take a few moments to complete, which I'm sure will be greatly valued by the company. On behalf of the management team of TR Property Investment Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.